At the end of the first quarter, the central banks of the large developed countries were very determined in their fight against inflation. Either they increased rates stronger than expected, for example, the Bank of England, or they made very clear that they go ahead with additional interest rate hikes, so made the Fed a clear statement that June was only a pause, and the ECB was clear in the determination to increase rates further at least one time in July. Looking forward, this will lead to a slowdown in economic activity, particularly in the manufacturing industry, and that on a global level. Monetary tightening is biting, and this is not that much the latest increases, but more than what has been done in the course of the last 12 months. And we see in the sentiment indicators around the world that the manufacturing sector is getting a hard time. And overall, this will lead to a slowdown in economic activity on a global level and probably a recession in the US. This will lead to a slowdown, not that much in the 2023 GDP data, but our forecast for 24 is revised downwards to around 1% for the US and the euro area. So the second half will give us a mixed bag in terms of economic activity. What about inflation? Here we think that the slowdown in demand is likely to dampen the pressure on the inflation side. Furthermore, we see some relaxation in the bottlenecks of the labor market as the corona-related disruptions in the border transmitting activities is coming down, and we see a significant drop in energy prices plus very benign base effects. So all in all, inflation is likely to go in the right direction. In that respect, growth is likely to be weaker, but some positive news from the inflation side. Just a look at the emerging markets. Here we have a different scenario regarding monetary policy. On the one hand, we have Turkey, where we have a huge amount of problems to get back the confidence of global investors. Therefore, we expect further substantial rate hikes to regain this confidence, but it will come at a cost, as we expect at least part-time recession in Turkey. On the other hand, we have China. There, the sentiment in the consumer sector is down. And here, not just monetary policy with further rate cuts, but also fiscal policy is likely to come in with stimulating packages. This is likely to help to get the Chinese economy back, but it probably will not be enough to propel overall global growth in the second half of this year. And as we have learned in recent days, geopolitical uncertainty is there as well and probably will be a drag on growth for the second half of the year. So, all in all, we are looking ahead for a mixed bag of information in the second half of the year, and monetary policy is likely to enter a phase where they wait and see what is going on, and we expect that they will stay on an interest rate plateau for the next couple of quarters.